Hello, this is Manash Patel with Ichimoku Trade. This is a additional workshop for week 2 for the 1 month mentoring. And the reason why we're doing a little separate workshop is that I want everyone to get familiar with the IMTF concept, which stands for Ichimoku Multiple Timeframes Analysis. And the reason why is that week 2 we're going to discuss pullback trading. This is where you have to find the key institutional support resistance. And this is where we're introducing this concept of IMTF in order to find these key institutional support resistances so we can place pullback trades. So I want everyone to start digesting this concept before we even get on the call for our second week of mentoring. So let's go through and discuss the origin of IMTF. To find these IMTF levels, what we needed to do was analyze all the issues we face as traders day by day in finding these key support resistance values. Okay, so there's pretty much 2 problems that traders face in finding support resistances. The very first one is where you get clipped, where you think you found the major support resistance, and basically you put an order there, you get clipped, where you get stopped out, and then basically goes in your direction. This is very frustrating, and pretty much every trader has gone through there. So let's go for a visual representation of this. This is exactly a picture here where you have a trend here, a bullish trend here, broke resistance, formed a pivot, did a pullback, and you're assuming that the pullback, which is a profit taking, is going to stop here at this black line. As a result, you're going to put a buy limit order here to buy at this black line, where you're hoping price is going to stop, reverse, and then start heading towards this pivot high and break it. And in this process, you have a stop, and what happens is you get stopped out in this trade, and then it takes off. So you're correct in your analysis in the direction it's going to go, but the problem is that your stop was not big enough in order to handle this trade. Okay, and if you look at reason why this happened is that the support in this example was not respected on a 60-minute. In fact, if you look at the higher time frame, the daily time frame, the support was a little slightly lower than the 60-minute support. So what happened was, in this scenario here, price came down to the daily support here, stopped, and then reversed. Now, most people are like, well, maybe I just need to sit there and look at the daily time frame support and adjust to that. No, you really don't know if price is going to respect the 60-minute support or daily support at all with high probability. It's random in nature, believe it or not. There's no statistics behind that says it's always going to support the higher time frame compared to the day trading and so forth. And the reason why is you don't know when these traders are going to show up with volume. 1 minute the day traders could show up all with volume, next minute these long-term traders could show up with volume. So you don't know that at all with high accuracy. Okay, so that's the first issue. The second issue is where you miss out on the opportunities. Again, you have the 60-minute trade, you have a pullback order here. Instead of sitting at price getting to the support where you enter the trade, it stops midstream and then basically takes off. In this example here, if you look at the lower time frame, the support was higher on the 30-minute compared to the 60-minute. And as a result, in this example here, basically price decided to respect the 30-minute support compared to the 60-minute. So now we've gone through 2 examples, one where the higher time frame support got respected compared to the 60-minute, and another example where the lower time frame got respected compared to the 60-minute. As I mentioned, this is random in nature. So if you think about that, that's the issue that most traders face. And the reason why most paid traders face this is that they're looking at one time frame only. They really don't look at the other time frames at all. Okay, so one of the things a lot of people try to do is they look at different time frames and then they start adjusting your stop. So if you look at the 60-minute trade, there's your buy, and if you adjust your stop below the daily time frame support, then what happens, your stop is here, and at that point your reward is here. And if you notice in the example here, this basically was a potential of a 3-to-1 reward risk ratio. Now what happens is you got a reward risk of 1-to-1 or less. So that's not good at all. So you can't really adjust your stops due to multiple time frames. If you do, you're going to add more risk, and at that point you're going to kill your money manager and your reward risk of 3-to-1 or higher. Okay, so that's not a solution at all. The only solution that's out there is doing what we call IMTF, the multiple time frame support. And what we're going to do in that concept is break things down into 3 zones. The very first one is what we call a day trading zone. This is where all the day traders are going to be, all the day trading supports and so forth. So it's going to be 1 minute, 3 minutes, 5, 10, 15, 30, 45. Then you have another zone, the swing traders. And these are basically 60 minute, 2 hours, 4 hours, and so forth. And the next is going to be the long term, which is going to be daily, weekly, monthly. Now, if you're trading one individual time frame, believe it or not, your probabilities are only for 30% if you're looking at only one time frame. But what we're going to do is we're going to define that probability and increase our probability of success. How do we do that? Well, we got to solve the two problems. So the only way we could do that is we got to make sure when we find a support resistance, it's matching across all three zones. What's that mean? That means our support or our resistance has to be the same for the day traders, swing traders, and long term. So if you find a key support resistance that basically matches across all three zones where the day traders, swing traders, and long-term traders are thinking the same way, now you got a high probability of it being a major institutional support resistance, and you got a high probability of it holding, because the chance of you getting clipped or missing out on the opportunity is going to be very slim. So that's what we're going to be looking for, is this IMTF concept that's basically the same support resistance across multiple time frames. Okay. Now, the details of this we'll go through the workshop when we go have the mentoring session, but I want to make sure you guys understand this concept before we get into the mentoring session, so you understand the route we're going to be taking and the methods we're going to be doing. So this is where we're going to start deploying the multiple time frame concept out there.